So if you were driving down the highway today, there's a really high probability that the vehicle next to you is being secretly piloted by the ghost of BlackBerry.
Yeah, that BlackBerry, the little plastic trackpad and physical keyboard from the mid
Oh,
2000s.
exactly. But obviously we are not talking about phones today. We're looking at a cybersecurity and automotive software powerhouse. And we are starting right off the bat with the latest price action because BlackBerry has been on a massive roller coaster this year.
Oh, massive is an understatement. I mean, we saw a jaw-dropping 138% year-to-date surge, hitting a high of $18.45, which was then almost immediately followed by this crushing 51% correction, down to around $8.98 where it sits now.
Right, which brings us to the core of today's analysis. Welcome to Market Pulse Daily, by the way. Our goal today is to figure out if this violent crash to $8.98 is a sign of a failing turnaround, or if the market is just, wildly misunderstanding a long-term opportunity here.
Yeah, and the main catalyst that kicked off that initial huge run was their Q1 FY27 earnings beat.
Absolutely. We're going to get into those fundamental catalysts in just a second, but really quickly, I need to mention our sponsor, StockOracle.
Right. So StockOracle is an AI-aided stock research platform for fundamentals, valuation estimates, moat analysis, bull and bear insights, comparisons, watch lists, and portfolio research.
Yeah, and you can find a special 14-day trial link below in the description. Just keep in mind that is an affiliate link, so the channel may earn a commission at no extra cost to you.
And of course, we have to say that StockOracle is not financial advice. It's not a buy or sell recommendation, a trading signal service, or real-time market data.
Right, and AI insights and valuation estimates can be incomplete or wrong. The data may be delayed, so, important facts should always be verified.
Always verified. But let's verify these Q1 numbers, right? Because for the quarter ending in May 2026, the revenue hit $152.9 million.
Which was up 26% year over year. I mean, they beat expectations across all three of their main business lines.
And that 26% top-line acceleration, that was the specific metric that just caught the market on fire.
Because for a company that has spent years in this really messy transitional phase, trying to convince Wall Street that they aren't a dead hardware brand, printing a 26% growth number.
It felt like total validation, yeah. It finally signaled that the structural changes they've been making were turning into actual cash flow.
But the money isn't coming from hardware, and it's not consumer apps. The absolute crown jewel here is their QNX segment.
QNX, right, which is an embedded real-time operating system. And like you said earlier, it's currently sitting inside roughly 275 million vehicles globally.
275 million. It's staggering. And to understand why a real-time operating system is so sticky, you kind of have to look at the mechanics of it.
Yeah, it's very different from a standard OS.
Exactly. A standard operating system, like on your laptop, it's like a busy restaurant kitchen.
Right.
Sometimes an order gets delayed because the chef is busy. If you open too many tabs, the system lags.
Right, you get the spinning wheel of death.
Yeah, exactly. But QNX is more like an air traffic control tower. It is deterministic.
Deterministic, meaning it has to happen exactly when it's supposed to.
Right. If a command says, deploy the airbag in 10 milliseconds or engage the anti-lock brakes, it cannot be put in a queue. It has to happen instantly.
And you don't casually swap out the air traffic control tower while the planes are already in the sky.
No, you definitely do not.
And that deterministic architecture creates this massive, what analysts call an incumbency moat.
Right, because in the auto industry, safety and reliability certifications take literally years to secure.
Yeah, if your car's infotainment system crashes and your music stops, it's annoying, right?
Yeah.
But if the real-time OS managing your advanced driver assistance systems crashes...
It's a catastrophic failure. People could die.
Exactly. So automakers simply do not swap out a foundational, safety-certified microkernel OS just to save, a few pennies on a license.
Once BlackBerry is integrated into that core architecture, they are locked in for the entire multi-year life cycle of that vehicle platform.
Which brings us to the really crazy part of their balance sheet, the $950 million QNX royalty backlog.
Yeah, almost $1 billion. And that backlog isn't just a hopeful projection, right? It's a legally binding pipeline.
Every single time a manufacturer rolls a car off the assembly line with QNX inside, BlackBerry collects a royalty.
They just have to wait for the cars to actually be built. The design wins are already signed.
Which is so rare in tech right now.
Yeah.
Very few industrial software competitors have that kind of guaranteed revenue visibility.
It's not just the auto sector that's driving this. We have to talk about their secure communications division, too.
Right, the other major pillar. Specifically, their recent NIAP Common Criteria certification for SecuSUITE.
And NIAP is basically the gold standard for public sector cybersecurity.
It really is. It's not just some rubber stamp label you pay for.
No, the software has to prove hardware-level sandboxing, mathematical proofs of encryption. It basically means if a government official has some compromised commercial app on their phone, that malware cannot break out of its partition to steal classified data in the SecuSUITE container.
And having that certification effectively locks in their ability to win sovereign government and intelligence agency contracts.
Right, because if you're bidding for Department of Defense or NATO infrastructure, you can't just say, our software is secure. You have to pass these grueling government frameworks.
It just eliminates so much of their commercial competition who can't afford or honestly just technically achieve that level of cryptographic isolation.
Okay, so if we look at the reality of the business in early 2026, it looks incredibly bullish. Revenue up 26%, an impenetrable moat in 275 million cars, a $950 million backlog, and government-grade security clearances.
I mean, if you're an investor looking at those fundamentals, you're thinking, wow, the turnaround is a complete success.
And the market absolutely priced it that way. Between late March and July 2nd of 2026, the stock went completely parabolic.
It really did. It climbed from a 52-week low of $4.05 all the way up to $18.45.
Yeah, the Q1 earnings beat alone triggered a 20% spike in a single day.
The market got totally swept up in this forward-looking growth narrative. They stopped looking at it as a legacy turnaround and started treating it like a hyper-growth software compounder.
They saw that 26% revenue jump, they saw the $950 million backlog, and they basically just modeled out a future where that exact growth continued forever.
Right, uninterrupted for the next decade.
But this is where the narrative kind of hits a brick wall for me. Because right after hitting that $18.45 high in July, gravity just took over.
Oh, it was a brutal collapse.
Yeah, it plummeted over 51%, dropping back down to around $8.98 in just 6 weeks.
And what's wild is that management even raised their full-year revenue guidance to up to $621 million for FY27.
Right. So if the core business is performing exactly how they promised and guidance is going up, why was the punishment so severe? A 51% haircut is massive.
Well, it comes down to a clash between that forward-looking euphoria and the actual trailing reality. The market aggressively ignored the baseline metrics during that run-up.
Because, yeah, Q1 showed 26% growth, but the trailing 12-month revenue growth, like the actual performance over the past 4 quarters, was only sitting at 4.82%.
Exactly. The stock price had completely detached from the financial gravity of the company.
So at the peak, investors were paying 88 times trailing earnings and 9 times trailing sales for a company that was averaging less than 5% growth a year.
Which is insane. I mean, paying a 9x sales multiple is aggressive for a pure cloud SaaS company growing at 40% a year.
Right, but applying that to an auto-reliant software company growing at 5%, it's absurd.
So that 51% drawdown, it wasn't the market deciding the business model was broken. It was investors waking up, realizing they had priced the stock for absolute perfection and dumping it the second the momentum stalled.
They just recalibrated the risk premium. I mean, a successful operational turnaround is great, but it doesn't automatically justify an 88x PE ratio.
No, not at all. The underlying business is objectively healthier today, but at $18.45, you weren't paying for the turnaround anymore. You were paying for flawless execution of products that haven't even launched yet.
Which leads us into this really fascinating contradiction when we look at the market sentiment and the analyst reports.
Yeah, the analysts seem to completely disagree with this brutal sell-off.
They do. CIBC Capital Markets recently raised their price target to $13. Raymond James bumped theirs to $9.50. Canaccord Genuity went to $10.30, and Zacks gave it a number 2 buy rank.
Every single one of those targets is above the current $8.98 price.
But despite that, net sentiment across retail and hedge funds is currently classified as mixed to cautious.
Because the institutional analysts are leaning on these mathematical discounted cash flow models, right? They plug in the $621 million revenue guidance, they model the $950 million backlog over 5 years, and the spreadsheet just spits out a $10 to $13 intrinsic value.
But the broader market is reacting to qualitative risks that don't fit neatly into a spreadsheet. And the biggest, most glaring risk right now is the internal behavior of BlackBerry's own executives.
Oh, the insider selling data. It is arguably the most damning piece of this whole puzzle.
Over the last 90 days, insiders have been net sellers, offloading over 322,000 shares.
And we have to talk about the moving share price ratio, or MSPR, because it sits at an abysmal negative 50.92.
Right, and just to clarify for everyone, this isn't just executives selling some shares to pay taxes.
No, the MSPR formula tracks the net direction and volume of insider trades relative to the stock's moving average.
So a score of negative 50.92 basically means that as the stock went vertical toward $18, the volume of insiders rushing for the exit accelerated right alongside it.
Which just raises a huge question about management's actual conviction in their own growth story. I mean, when the directors who have the most intimate knowledge of the immediate pipeline are aggressively selling into a spike.
It's a glaring red flag.
They looked at that 88x trailing earnings valuation and made a calculated decision that the stock was overvalued.
It makes it really difficult to defend those bullish analyst targets when the exact people managing the $950 million backlog are dumping hundreds of thousands of shares.
You can't point to a multi-year pipeline as a reason to buy at $18 if insiders are using that same pipeline as exit liquidity.
It heavily suggests that management knows the ceiling is much lower than the market thought.
And while analysts project this smooth, linear revenue realization, management is acutely aware of the macroeconomic headwinds.
Yeah, the cyclical auto risks. Because despite the software pivot, they are fundamentally tethered to the global automotive industry.
Which Wall Street often misprices. Software investors love the predictability of recurring revenue, right?
Right. But QNX licenses are tied directly to physical unit production.
So if interest rates stay high, auto loans get too expensive, and consumer demand for new cars craters.
The OEMs, the original equipment manufacturers, they're going to slash production targets.
And the second vehicle production slows down, the pace at which BlackBerry converts that $950 million backlog into cash slows down with it.
They have the high gross margins of a software company, sure, but they suffer from the industrial dependency of an auto parts supplier. OEM spending cuts can throttle QNX overnight.
Regardless of how good the operating system is. And that cyclical exposure really limits the premium a rational market will assign to the stock.
So we have this solid QNX foundation, extreme valuation whiplash, heavily negative insider trading metrics, and these cyclical auto risks. But here's where it gets really interesting.
The wild cards.
Yes, the wild cards. Because BlackBerry's strategy to break out of this valuation trap involves their unreleased catalysts, specifically the Alloy Core platform and a major partnership with NVIDIA focusing on physical AI.
And this is the exact narrative that fueled the craziest speculative buying during the spring rally.
So what exactly is Alloy Core? Modern cars have dozens of separate electronic control units, handling everything from windows to the transmission. Alloy Core is designed as centralized middleware.
Right, a software-defined vehicle tier that abstracts all that raw hardware. It basically acts as a universal translator, letting automakers write high-level apps for the car just as easily as writing an iPhone app.
And management projects that integrating this middleware, especially alongside NVIDIA's AI hardware for advanced driver assistance, creates immense value. It saves automakers from writing custom low-level code for every single sensor.
And the CFO stated on record that pricing discussions for Alloy Core are underway. Internal models suggest it could triple the revenue they currently generate per vehicle.
Triple it. I mean, if you take 275 million vehicles and suddenly triple the revenue extracted from each one, the mathematical upside is just staggering.
Which is exactly what the market modeled out during the run to $18.45. But we need a serious reality check on the execution risk here.
Right.
Because as of right now, BlackBerry has 0 signed customers for Alloy Core. 0.
Wow, yeah. And on top of that, the physical AI and robotics stuff they're exploring with NVIDIA, it's in the earliest stages of conceptual development.
It is completely unproven as a reliable commercial revenue driver.
So the market was pricing the stock based on a polished pitch deck and theoretical pricing discussions rather than actual signed purchase orders.
Exactly. If they actually get binding contracts, Alloy Core is a massive catalyst. But if negotiations stall or if OEMs push back on the cost in a high interest rate environment, that triple the revenue narrative just completely vanishes.
And when your stock relies on a forward-looking growth story, a narrative collapse like that is devastating.
It forces investors to reevaluate the risk-reward. That 51% drop was basically the market forcefully removing the premium for Alloy Core until management can prove they have a signed contract.
So the current $8.88 valuation reflects the existing QNX business, but it assigns almost zero value to the speculative AI and middleware upside.
Which brings us directly to the upcoming make or break moment. We have to watch the Q2 FY27 earnings report in late August or early September.
Right, the financial guardrails are set. Management needs to hit their revenue guidance of $137 to $148 million and deliver adjusted EBITDA between $20 and $30 million.
But honestly, just hitting those estimates probably won't spark a major recovery. The market needs proof. They absolutely have to announce a signed customer for Alloy Core.
Without that concrete update, institutional patience is just exhausted. They need to see commercial viability validated by a major OEM.
So what does all this mean for the final outlook on that $8.98 share price?
Well, it suggests the stock is currently suspended in this volatile neutral zone. The sell-off purged the speculative froth and priced in the execution risks. But even here, they still have to sustain double-digit top-line growth to justify the market cap.
It is a perfect case study in separating a genuinely impressive operational turnaround from the hype cycle of the stock.
Absolutely. Before we wrap up, just a quick reminder to hit subscribe if you're enjoying today's breakdown. And don't forget to check out that StockOracle 14-day trial link in the description. It's a fantastic AI-aided research platform for fundamentals, valuations, and moats. Just remember, it's not financial advice, and always verify the AI insights.
But just to leave you with one final provocative thought here, BlackBerry achieved something remarkable just by surviving the death of the smartphone era.
Yeah, they embedded themselves into the critical infrastructure of the modern car. But with this new NVIDIA physical AI focus, the applications go way beyond passenger vehicles.
Right. If QNX is already the gold standard for secure, deterministic, real-time operating systems in complex machines.
What happens when cars aren't the only autonomous machines we interact with? We're talking about autonomous humanoid robots, drone logistics, massive industrial robotics.
Every single one of those machines will need a fail-proof operating system to prevent physical accidents.
Could the most secure, dominant software architecture of our automated future actually belong to the exact same brand we once associated with a plastic trackpad? It's a fascinating transition to watch.
The architecture of the early 2000s mobile revolution might literally become the central nervous system for the robotics revolution of the 2030s.
Definitely a vital narrative to track heading into Q2 earnings. Thanks for joining us on Market Pulse Daily.